Remember life cycle. So meaning that we look at the flow of the economy. At what point? So we look at the fluctuation of the economy. At the period of fluctuation, we bring in control measures using the cyclonic, counter-cyclonic measures. Number 4, rule-based policy. Under this rule-based policy, money supply and related variables are controlled by the predetermined rules and norms and standards. So rules are used in controlling the supply of money and the demand of money in an economy. Under this rule-based policy, money supply and related variables are controlled by predetermined rules, norms, and standards. Discretionary monetary policy. Discretionary monetary policy allows the central bank create autonomy in the conduct of monetary policy. Under such a policy, rather than getting constrained by the preset rules, the central bank, after assessing the emerging economic scenario, using its own judgment, can change the values of money supply and the related variables. So again, this is under the hands of the central bank. So the central bank will bring forward control measures based on the emerging issues in an economy. If there is catastrophe or if there is a pandemic, the central bank will bring forward discretionary monetary policies based on what is happening in the market, what is happening in an economy, what is causing an economy to behave the way it is behaving. So these are the critical types of monetary policy. So we are moving now to the instruments of monetary policy. Now, in the instruments of monetary policy, we have two critical measures or instruments or weapons of monetary policy. Number one weapon is quantitative. In quantitative, there are 4 types of instrument: bank rate, open market operation, cash reserve ratio, statutory liquidity ratio. So these are the quantitative measures or weapons. Or other books talk about indirect methods. So qualitative method is a direct method which the central bank uses to control an economy. Number 1 is credit rationing. Number 2 is specific control. Number 3 is direct control. Number 4 is moral. Number 5 is agreement, gentleman agreement. So these are the types of credit control measures or instrument. So we'll look at the first one, quantitative measure or quantitative weapon or tool or instrument. Interest rate. The rate of interest charged by the central bank for providing loans to the banking system. So these rates are actually provided by the central bank. So it is the mandate of the central bank to set the interest rate. This banking system involves commercial banks and cooperative banks, industrial development banks, and other approved financial institutions. Funds are provided either through lending directly or rediscounting or buying money market instrument like commercial bills and treasury bills. So this is an instrument whereby the central bank will withdraw money from the public to bring forward contraction or expansionary policy into play. So it is very important. When the interests are high, more money in the market. When interests are high, less money in the market. When interests are low, more money in the market. At the same time, when they sell securities, they withdraw money from the public. When they buy securities, they release money to the public. Number 2 is the cash reserve ratio. A certain percentage of bank deposit which are required to keep with the central bank in the form of reserve or balance. So all banking institutions are required to keep a reserve with the central bank. Higher the cash reserve ratio with the central bank, lower will be the liquidity in the system, and vice versa. So the lower the credit reserve ratio with the central bank, the higher will be the liquidity. So again, this is another way the central bank can control. So it is in between 3% to 15%. So if it is 15%, low liquidity. If it is 3%, higher liquidity. Number 3, open market operation. This is another form which is indirect way of central bank controlling money in the market, an instrument of monetary policy which involves buying or selling of government securities from or to the public and banks. So when the government buys security from the public, what happens? They are releasing money to the public. When the government sells security to the public, what happens? They are withdrawing money from the public, pumping money out of the market, pumping money into the market. That is the game in the open market operation. This mechanism influences the reserve position of the banks, yield on government security, and cost of bank credit. Number 4, statutory reserve ratio. Every financial institution has to maintain a certain quantity of liquid asset with themselves at any point of time of their total time and demand liabilities. These assets can be cash, precious metals, approved securities like bonds, etc. The ratio of the liquid asset to time and demand liability is termed as statutory liquidity ratio. So this is the ratio of liquidity of moneyness, the cash flow in the central bank. All the banking institutions must keep a liquid reserve, and this reserve must be in the form of metals, approved securities, or cash. So the ratio shows a relationship between the liquid asset to time and demand liabilities. Qualitative measures. Qualitative measures are direct measures which the central bank uses to control money in the market, supply of money and supply of credit in the market. One is, under this method, there is a maximum limit to loans which the commercial bank cannot exceed. So, a maximum limit which the commercial bank has put forward. Central bank fixed ceiling for specific categories, such as used for institutions which credit flow is to be checked, particularly for speculative activities. So a ratio is put, and this ratio must be controlled by the central bank. So the ratio will help the other financial institution to actually advance loan or withdraw loan from the public. Leading margin. Leading margin is also called requirement margin or requirement of loan, equals to current value of security over for loan value of loans granted. The marginal requirement is increased for those business activities the flow of whose credit is to be restricted in the economy. Moral situation. The central bank of a country, being the apex, uses here is that of persuading the commercial banks to follow its directions order on the flow of credit. So it is actually a persuasion technique. So the central bank will persuade the commercial banks to follow their order on the basis of credits. Central bank puts a pressure on the commercial bank to put a ceiling on credit flow during inflation and be liberal in lending during deflation. So this is actually critical. So the central bank will advise or will persuade the commercial bank to put a ceiling. When there is inflation, there must be a ceiling. And when there is deflation, liberal lending must be put in place. Direct action under the Banking Regulation Act. The central bank has the authority to take strict action against any of the commercial banks that refuses to obey the direction given by the Reserve Bank or the Central Bank of Kenya. There can be a restriction on advancing of loan imposed by Reserve Bank of India on such banks. Demand liability is termed as statutory liquidity ratio. So it is the requirement of the central bank to put some regulation, to put some direction, and they have been given authority by the act of the government, which is under act of government by the central bank. So they can actually issue an order, and all commercial banks or financial institutions must obey. Failure to do so, they will take some action. Gentlemen, these are voluntary agreements between the central bank and banks aimed at improving monetary conditions in the economy. This is actually a simple way of gentleman agreement. Just agree and sort out the issue. Most countries like Tanzania has been actually using the gentleman agreement. So the Central Bank of Tanzania has been applying the gentleman ratio. Now limitations. If there are positive side, then there are shortcomings. What are the shortcomings of monetary policy? Number one, time cap. Number one is time cap. Number two is forecast difficulties. Number three is non-banking financial institution. Number four is underdevelopment of monetary market. And number six is underdevelopment of financial institution. And finally, corruption. So there are other factors, you can mention them, but I want us to look at this. Number one, time cap involves time taken in formulation and implementation of monetary policy in an economy. Number two is forecasting difficulties. Forecasting economic condition has been a controversial issue. So there is controversies based on forecasting. Then number three, non-banking financial institution. The growth of financial market has decreased the scope of monetary policy. Number four, underdevelopment of money market act as a major factor of inefficiency of money market. So underdevelopment because of the underdeveloped countries. Then number six is developing countries are not well developed. Then finally, corruption. Developing countries make instrument ineffective. Thank you so much. See you in the next lesson.